Hey value investors, thank you for joining me. Right now I'm going to discuss a stock with you and get into some graphics. But before that, don't forget to subscribe so you can get my next value installment. Also, come over to our marketplace, Deep Value Returns on Seeking Alpha, and do a free trial. Find out which stocks I own and why. I come up with one new investment idea a month. Let's get started. So value investors, I want to talk about Tencent and why I believe Tencent is undervalued. So we're going to talk about its growth trajectory, diversification of revenue, Wechat, its valuation, and then I'm going to note the potential risk. So let's dig in. Tencent's revenue growth rate is quite strong. It has quite consistently been hitting around 20-25%. So this type of sustainability is very, very attractive. And I don't think in the near term we're going to see Tencent's revenue growth rates coming down below that level. It has a lot of different potential. But what I will say is that this thesis here, the bullish thesis, is contingent on approximately 20% growth rates. If the growth rate comes down to approximately 15%, then investors are probably getting fair value, if not overpaying for Tencent's revenue growth rate into the future. What I will say is that in the past, what put me off from Tencent was that its revenue was very much contingent on online gaming. You may be able to see here that in the past, online games made close to 50% of its revenue. And right now, that's come down significantly, and it's come down to approximately 33%. So in the past, I was quite fearful because I felt that gaming industry is quite hit and miss, and it's very unpredictable whether you can come out of game blockbuster after blockbuster after. What I didn't appreciate sufficiently in the past was that in the case of games is that it can have a franchise. So if you have one game that's a success, it's not impossible to have the second game in the franchise come out, and the third game, so you can just really layer that on. So I didn't give enough weight to that in the past, and I think that was probably foolish in hindsight. I do think that not only is it a diversification away, but it's a very high profit margin company. So it's hitting around about, on a non-IFRS, it's hitting around 34% operating margins. This is very, very appealing. It's a very asset-light company, and it can make a lot of profits for investors down the road. Another avenue I want to touch on is Wechat. So Wechat is kind of similar to WhatsApp, but there's a lot more functionality. You can hire a taxi or pay for the doctors with Wechat, so it's not really like WhatsApp. Although Wechat has 1.2 billion monthly active users, which puts it behind Facebook's family of platforms that I think may have around 2.4, even 2.5 billion now monthly active users. So it is not as big as Facebook's family of apps, but 1.2 billion is nothing to sneeze. Finally, I want to talk about its valuation. So I'm a value investor, and for me, everything really boils down to valuation. If you get the wrong valuation, you can get the best company in the world, but it's going to go wrong. You need to be very careful with the valuation. This is something that I do not mess around with. For me, it's very, very critical. And I think that here we can see that a very high asset-light company, very high margin asset-light company, should not necessarily be trading at 12 times sales. And you can see that back in 2016 and 17, when investors were positively euphoric over Chinese stocks, and there was a whole bull market of the bad stocks, like Baidu, Alibaba, and Tencent. These companies were just going vertically north at the time, and I wasn't participating in those stocks back then, but I do think that the valuation has come down a little bit, so it could in time re-rate higher. But to be clear, this is not part of my bullish thesis right here. So my bullish thesis is that it remains relatively steady, the multiple at 12 times, even if you get a little bit of an extension on the upside. That's not what I'm counting on. I'm just counting on Tencent's revenues growth rates staying at approximately 20-22% over time, and that is where the return should come from, not from a multiple expansion right here. Now, I want to mention one investment risk, which I think can be quite important, because it is a Chinese company, and although I don't think that the long-term shareholder of Tencent will be impacted by any tensions between the US and China, in the interim, in the short term, there can be a lot of volatility between US and China, which can have a large impact. It appears to be an overarching impact on Chinese stocks. So I do think that that is something to be mindful of. And I don't like this idea of the new normal, but I do think that when it comes to like right now, I see that there's a discrepancy between US companies and Chinese companies. So I think that, I'm not sure if it's down to interest rates or not, but in the US, stock market is really kind of going ahead, and whenever I felt, okay, this is extremely overvalued, it would just kind of go off another 50% higher. So we went through that March downturn, which was just a flash and it was gone, and now we're kind of back to normal, even higher for many stocks. So I don't know if that's down to interest rates or what that's down to, but I do see a discrepancy between Chinese stocks and US stocks, and you don't need the Chinese stocks to re-rate anywhere as high as the US stocks, but I do think that that kind of offers some margin of safety. So I may go long Tencent, and if I do, obviously I will not have a chance to notify you. And today we discussed its growth trajectory, the diversification of revenue coming from gaming. We talked about Wechat. We discussed at length its valuation and a potential risk. So as always, don't forget to subscribe. Bye.